Which are the best investments during the last 100 years and which countries around the world performed the best? Those are the questions we're going to answer in this video. These are probably one of the most important facts one must find out. Hello and welcome to the Market Watcher, a place for gathering traditional financial and crypto knowledge on a regular basis. Subscribe to the channel, like the video and hit the thumbs up button if you don't want to miss out any of our content. As always, everything said in this video is with educational purposes only and it should not be considered to be financial advice. In this video lecture, we'll examine the real returns of government bills, bonds, traditional stock equities, and we will see the inflation rate. The analysis will cover only the real returns of all of those assets, which means that from the nominal return we subtract the inflation rate. For example, if a certain stock equity has risen by 10% for a 1-year period, but at the same time the inflation rate is 5% for that year, the real return is only 5%. This is called real return because when the prices of all goods and services have risen by 5%, our real purchasing power from our investment has increased only by 5%. If the return on the investment is 10%, while the inflation rate, which affects all products and services in the economy, is also 10%, then our real return is net zero. Now that we know this, we can continue with our analysis. We will cover 16 of the most developed countries in the last 100 years. At the end, we'll discuss the average real returns for all of them and the average inflation. The analysis is done by Map Faber, which is one of the best backtrackers of financial data in the world. Just a side note, government bills in the US are called treasury bills and they cover the shortest term bonds. Usually a bond with a time horizon of a year or less is not called a bond but a bill, while all government bonds with a time horizon of more than a year are called bonds. Let's start with Italy. Over the last 114 years, Italy had an average inflation rate of 8.2%, which is the highest average inflation out of all 16 developed markets, which Map Faber evaluates. This gives Italy also the worst investing performance. Its short-term bonds had a minus 3.5% real return, its long-duration bonds have had a minus 1.2% return, while the Italian equities on average gave returns just of about 1.9% annually. Belgium is next on the list for worst performing equities during the period with an average return of 2.7% annually. Its shorter bonds gave investors a minus 0.3% return, while its longer duration bonds gave out a positive 0.4%, which means they beat out the average Belgium inflation rate of 5.2% on a real basis. But still, the returns are abysmal for a true investor. During the last 100 years of data, the inflation rate of Belgium was 3.8%. This gave it a real return on its short-term bonds of minus 0.3%. Belgium's inflation, though, is not the second highest. The second highest average inflation for the period is belonging to France, which had an inflation rate of about 7%. This inflation has made it so that the French short-term bonds are yielding a minus 2.8%, while the longer-term bonds are yielding a positive 0.2% on a real basis, while the French equities are with a positive 3.2% real return. The third highest inflation is seen in Japan with a 6.8% and both short and long-term bonds are yielding negative returns with a minus 1.9 and minus 0.9% respectively. It is important to note that over the long term, higher duration bonds with a longer time horizon will always yield more than shorter term bonds. This is due to the fact that an investor has more risk when he buys longer duration bonds. This risk must be compensated with a higher yield. This is due to the fact that it is much easier to know and analyze a country's economic and financial health in the next year than it is to analyze it with accuracy over a period of 10, 20, or 30-year horizons. Japan's average equity return for the period is 4.1%. Spain is sitting at number 4 when it comes to inflation levels, with a level of 5.7%. But surprisingly, it has positive returns for both its short and long bonds, with 0.3 and 1.8% respectively, while the Spanish equities have returned to investors 3.7% on average on an annual basis. On the other side, the countries with the lowest average inflation rates are the Netherlands and the United States, with both an inflation rate of 2.9%. Short-term Dutch bonds are returning on a real basis 0.6%, while the US's so-called treasury bills are returning 0.9%. Long-term Dutch bonds have a 1.7% return, while the US bonds are returning 2% on average. While when we look at the equity side of things, Dutch stocks have a 5% real return, while American stocks have returned 6.5% per year for the entire period on a real basis. The interesting data shows that the US stock market has not been the best performer, contrary to popular beliefs. Two other developed markets have managed to beat out the US stock market. The first one is the Australian stock market, with an average real equity return of 7.3%. The average inflation rate in Australia for the period of 1900 to 2014 was 3.8%, while its short-term bonds generated a 0.7% real return, while bonds had a 1.7% real return. The best performing equities market during the period was the South African stock market, with the very impressive 7.4% on a real basis. The return was accomplished even with a much higher inflation rate of 4.9%, while the returns for the short and long-term bonds are 1 and 1.7% annually. We still have not mentioned the long-term emperor of the world, the United Kingdom, which before the US was the main economic and financial empire. They had an average inflation rate for the period of 3.9%. Their short-term bonds yielded 0.9%, while the long-term bonds had a 1.6% real return. The UK stock market, on the other hand, provided their investors with a 5.3% return. The country with the lowest inflation level for the period is Switzerland, which had only a 2.2% inflation. This yielded investors in Swiss stocks a 4.5% average real return, while short and long-term bonds gave out 0.8 and 2.3% returns. On the screen now, you'll see the other main developed countries and their returns: Canada, Denmark, Germany, and Sweden. We do not see average inflation for Germany because they experienced a hyperinflationary moment which destroyed the German mark around 100 years ago. It is important now to see the average returns for all of those developed countries so that we know which ones are underperforming and which ones are overperforming those general numbers. The average inflation for all of those 16 developed markets was 4.5%, while on average Short-term bonds yielded exactly a net zero return, meaning they were on par with inflation. Long-term bonds had a 1.3% real return for the period, while stocks gave out 4.7% returns to their investors. Now you know the history of all developed markets, their results and performances, but it is important to note that past performance does not indicate future results. With that said, I want you to subscribe to the channel, like the video, and comment if you appreciated our content. I love reading all the comments, so feel free to share your thoughts down below. Good luck to all of you, and I'll see you in the next video.